I've recently made a video on Amazon, saying that Amazon will have explosive profits. I believe in the near future, Amazon is going to produce a ton of free cash flow, and I'm invested in the stock. I've also talked frequently about Netflix. Currently, Netflix has a lot of positive things. There's so many things going right for Netflix right now. But the next company I'd like to talk about is another one in my portfolio. Here in the Story Fund, I have my major top holdings: Amazon, Netflix, and the next biggest one by far is Google. Google's one of my 6 positions in this portfolio. $35,000 of total value in this company, 8,500 of that being gains. Now, Google has had a wonderful past year. In the trailing 12 months, it's up 48%. That's led a lot of investors to exit the stock and take their gains, believing that the majority of gains are already behind Google. Now, that could be the case, but I think there's reason to believe that the gains are not finished for Google and that this company can continue to sail higher and higher. And it's because of one issue with the company that they finally seem to be addressing. That is the issue of employment. Google has a problem, and they've had this problem for a long period of time. It goes back years, but it's more of an egregious problem with Google than any other big tech company. The issue is with overhiring and overpaying. There's a hedge fund manager named Chris Hone that runs TCI Investments. He's one of the good hedge funds. He's really good. His performance is astronomically good. And one of his largest, most concentrated positions has been Google. This is an 8% holding for him, which he has billions and billions of dollars invested in. Early 2023, he wrote a letter to Sundar Pichai, the CEO of Google, saying that based on all of the data, all the comparables, other big tech companies, other companies similar to Google, they have too many employees and they're paying those employees too much. He called for a reduction in headcount of over 20% of the employees. Now, looking at that at today's current headcount, it'd be more like 30% of the current employees. So this is a very large hedge fund manager saying that Google needs to lay off a lot of employees to get their cost structure under control and to make this stock soar. And it seems like it was a hard thing to call for, a difficult thing, but we saw Meta do this. Mark Zuckerberg did something very similar. He just phrased it the year of efficiency. Once he called for the year of efficiency, Meta stock turned around. It went almost vertical. It went up 200%. Now, this year of efficiency that Mark Zuckerberg was able to pull off is the same thing that Google shareholders want. They've been asking for this for a number of years. They want the company to run more efficiently, similar to its peers. And so far, Google has been held back because Sundar Pichai has been unwilling to fully commit to the year of efficiency, to making sure that Google has good cost control. Now, it appears that the time has finally come where Sundar is deciding to address this issue, and we're going to be looking at how he's addressing this issue. Now, before we look at that, we need to understand the issue itself completely. The big problem comes down to too many employees with too much compensation, and this shows up in the numbers of the company. See, a company like Google pays employees in 2 different ways. They have their normal salary, which is cash that they pay the employee every 2 weeks. This is your salary you receive. And then there's stock-based compensation. That is where they receive RSUs or options, whatever it may be, where they get shares of the company that are vested over a certain period of time, and then they get the value of those shares. Now, in terms of accounting, on the financials, they like to bucket these into different categories and treat them entirely differently, but they're not different. They are both worth cold hard cash. If you believe Google stock is worth $147 per share, then every share they give away is like giving away $147. So whether it's stock-based comp or salary, potato, it's the same thing. When you pay employees in either one, you're giving value to the employee. Let's go ahead and take a look at how this problem appears in Google. And we'll start off by doing a couple comparables to set the foundation, just to set the stage here. This is MasterCard, and you could use Visa as an example as well. If we look at MasterCard and then we bring up their free cash flow, it'll show that the company, like a lot of these great tech companies, has growing free cash flows over time. You see the chart growing almost every year over time. If we flip this to annually, we can see the growth in the free cash flow. Not perfectly every year. No company's going to have perfect free cash flow growth, but it's over time growing at a pretty decent pace. It's doubling over a 5-year period. That's really fast. Now, This is one part of the equation. The other part that the financials miss in a lot of cases is factoring in that other half of employee compensation, the stock-based comp. Since technically it's not cash, they treat it entirely differently. But again, it's basically the same thing. If you give away a share, you're giving away the equivalent value of that share in cash. It's just bucketed in a different category. What I did here with Qualtrim is allowed you to see them side by side. And what we can see with MasterCard is the blue bars here, these bluish purple bars, the stock-based comp next to the free cash flow. You see how it's a tiny fraction of the total free cash flow? For example, in 2022, the free cash flow MasterCard generated was $10.1 billion. The stock-based comp was $293 million. So they don't have much of a problem with paying employees too much. The huge, vast majority of free cash flow is not diluted away. And employment only makes up for a small portion of the actual costs there. Now, if I look at this mathematically, we actually have it calculated right here. We can zoom in and see that the free cash flow yield of MasterCard is 2.4%. The stock-based comp adjusted free cash flow yield is 2.3%. That means that's the yield after factoring in the total compensation for employees, leaving the stock-based comp impact at 4%. So 4% of your free cash flows are eaten up by stock-based comp. That's really good. That's really efficient. It's not zero, but it's 4%, which is super efficient. Let's go ahead and take a look at another company here. We have another one of my holdings, S&P Global. If we look at this one, we can again go to the free cash flow chart here. We bring this up and you can see something similar. Let me try to blow it up here a little bit. We see the free cash flows getting more steady and growing over time. And then if we want to look at the stock-based comp next to it, we can see the tiny blue bars there. You can barely see them. Let's go ahead and switch it over to annually here to see if you can see them. All right, we can go like this. We can zoom into the past 10 years. We can flip over to stock-based comp there. And there you have it. The free cash flow last year was $2.51 billion. The stock-based comp was $200 million. And as you can see visually, it is a fraction of the total pie here. S&P Global is very efficient. They earn a lot of cash flows with a few amount of employees. And the employees that they do have, they don't pay anywhere close to Google's employees. Employees at S&P Global aren't making $400,000, $500,000. They're not making upwards of $1 million per employee. So they have more reasonable costs with this company. And that means that the stock-based comp impact on their cash flows is very minimal. It's not quite as good as MasterCard's, but it's still only at 5.8%. So 6% stock-based comp impact. So MasterCard had a stock-based comp impact of 4%. S&P Global's was 6%. Now let's go ahead and take a look at Apple. Let's see how inefficient or efficient this company is. Now, if we go down to the free cash flow chart here again, we want to see this visualized. And this shows the cash flows from the beginning of time, all the way back to 1989. So we want to zoom into the past 10 years. More relevant here. Generally speaking, every quarter seems like it's a little bit higher. Now let's go ahead and take a look at it compared to the stock-based comp. Again, we want to see if the stock-based comp is disproportionately huge compared against the free cash flow. That may signify that the company is not running that efficiently. With Apple, we see that the stock-based comp is also very low compared to their free cash flow. You have the free cash flow all the way up here. You have the stock-based comp way down here. When we look at the math here, the free cash flow yield before stock-based comp is 3.36. The free cash flow yield after stock-based comp is 2.99, meaning that stock-based comp has a 10.8% impact on Apple's free cash flows. Now let's take a look at one more before looking at Google. We'll take a look at Microsoft. So we open up Microsoft's free cash flow, we zoom in over the past 10 years, and we look at the free cash flow and stock-based comp. And here you can see that Microsoft's is a bit higher than Apple's, but not much. Last quarter, they generated $20 billion of free cash flow and $2.5 billion of stock-based comp. So this looks like it's under control. It's pretty efficient. It's not perfectly efficient. It's not MasterCard or Visa, but it's decent. It's an efficiently ran company. In total, the stock-based comp makes up for roughly 15% of Microsoft's free cash flow. So just to review, every company we've looked at, MasterCard's was 4% impact, S&P Global's was 6%, Apple's was around 10 to 11%, Microsoft's was 15%. So anywhere from 4% impact to 15%. Now let's go ahead and take a look at Google. We bring up the free cash flow chart here, and I have to say, this is a beautiful free cash flow chart. I've looked at a lot of them from a lot of different companies, and this one is gorgeous. So Google has something special here. Their search business is a money printer. Now let's go ahead and take a look at the issue. We zoom in over the past 10 years, and we look at the free cash flow compared against the stock-based comp. And here you can see the issue a bit more clearly. In 2023, they did $22.6 billion in free cash flow. That's a ton of money in free cash flow. But they also paid $5.74 billion in stock-based comp. That is twice as much as Microsoft. So they earned roughly the same amount of free cash flow as Microsoft last quarter, but they paid their employees twice as much in stock-based comp. That is the main issue with Google, unlike all these other companies. Google also has the best valuation today of any of these companies before factoring in stock-based comp. For example, the free cash flow yield right now is 4.19%. But after you take out stock-based comp, after you factor that in as part of the equation, the free cash flow yield goes down to 3%. Goes down a lot. The total impact of stock-based comp on Google is 28%. So we know the problem here. Google's not running as efficiently as it should. Now, we know that Google's never going to be as efficient as Visa or MasterCard or S&P Global. That's just never going to happen. Those companies are uniquely efficient. But Google could run as efficiently as Microsoft. And if you say it can't, well, why not? Why can't Google run as efficiently as Microsoft? Google has the search engine, which is more highly efficient than almost any part of Microsoft except for Bing, which is their search engine business. Google has cloud, just like Microsoft Azure. Why is Google not as efficient as Microsoft? There's really no excuses for it. Google should be running as efficient or more efficient than Microsoft. And I did do the math on this. If they ran as efficiently as Microsoft, just with their stock-based comp alone, the company would have 17% gains based on its valuation today. In a straight valuation, but also the valuation would likely increase, meaning the gains would be more than 17%. There's a lot of upside to Google if this company can run more efficiently, and I believe they can. I see some evidence of that happening right now. Let's go ahead and take a look at a couple pieces of evidence. The first thing we can look at is the employee count over time. We have this chart here in Qualtrim that shows the amount of employees per year as reported on their 10K. We can see that over time, Google has increased their employee count from 2015 being 61,000 all the way up to 2022, 190,000. 2022 having 190,000 employees was huge. They hired so many employees. They're hiring 20, 30,000 per year. In one time period, Google hired roughly 30,000 employees in 9 months. So they're on a hiring spree, just bringing on more employees in every part of the company. Well, let's go ahead and take a look at the latest earnings report of the company. We can look at the employee count as reported in Q3 of 2023. Is it going up or down? We look at this, and the employee count in 2023, right here, is 182,000. The number went down. They didn't just slow the growth of the amount of employees. They didn't hire at a reduced pace. They actually reduced the total number of employees from 190,000 to 182. So we're seeing some real reduction in headcount at Google. And then we also have some news just recently that Google is planning on cutting even more employees, hundreds of jobs across engineering and hardware teams. CNBC reports that Google cut several hundred jobs across the company late Wednesday night as it continues to push for efficiency and focus, its biggest product priorities. The year of efficiency. Mark Zuckerberg did it. That caused the stock to turn around. Google's starting to look like it's doing it right now. Wall Street's not convinced because Google's done this head fake before where they said they're going to become more efficient and they really didn't. But the numbers don't lie. It looks like they're actually doing the year of efficiency. The layoffs will impact employees within Google's hardware and central engineering teams, as well as workers across Google Assistant, its voice-activated software product. Other parts of the company were also affected. Now, this isn't just layoffs in one portion of the company. Every major division of Google's having people get cut from it. That's sad for those employees, but I think they're going to land on their feet. They have Google in their work history, and these are sharp people that were working at Google. They're not going to struggle looking for a new job. The announcement marks the latest cost-cutting effort at Google as it works to rein in the dramatic headcount growth it pursued during the pandemic. Last January, Google slashed its workforce by 12,000 people, roughly 6% of its full-time employees. The company made other cuts to its recruiting and new divisions later in the year. So we have directly from the CEO of the company that they're continuing in their cost-cutting effort, reducing the amount of employees. We can see that this is a continued theme for Google. And we know that if they get closer to Microsoft in their efficiency, the gains should stack up for Google stock. Now, I went through and ran a couple scenarios based on this equation of Google becoming a little bit more efficient with their spending. And I have a bull case here, assuming 10% revenue growth, the margins expanding a little bit closer to Microsoft's over time, then maintaining their CapEx spend to grow their cloud business and medium predictability. When I factor all of this in and look at the outcome, I see a range of scenarios for Google that I think are all decent. At a 3% free cash flow yield in 2028, based on these assumptions, it would have a 16% annualized return. Even if the company trades at a 4% free cash flow yield, that's not a great valuation for Google, so that's not the best case scenario, but it still would return 9% per year. That's still a really healthy return for a higher free cash flow yield, which means a lower valuation for the company. Now, if things became more efficient, the valuation should improve. The free cash flow yield should go down. So this company could give upwards of 20% returns if it traded at a 2.5% free cash flow yield, which I think Google could if they resolve some of their concerns around search and if they become more efficient. But right now, I believe that this company is well set up to give 13 to 16% returns. Really good returns for a really good company. Now, this is the bull case for Google, if they really try to become more efficient, if they follow with Mark Zuckerberg's path. We also have the bear case here. This is if revenue doesn't grow quite as fast, if they don't become quite as efficient, and if they don't rein in their CapEx at all. In this bear case, Google still gives positive returns. They're not as good, they're 4 to 7%, but they're still decent. Most of the scenarios for Google today are positive returns over the next 5 years. Now, obviously, there's a possibility of some super bear case where Google search gets disrupted and the company tanks. There's always a chance of that, even though I think it's very unlikely. But overall, when I look at Google, when I look at the potential upside and efficiency, when I look at the businesses they own and the reasonable valuation it trades at today, I think there's ample upside for this stock without taking on too much risk. So I'm going to stay invested in it. We'll see how it does. Let me know if you like this episode. See you in the next one.